Hello there, welcome to The Open. Here are the big stories we're bringing you from our newsroom. TD Bank posted profit and revenue in its latest quarter that topped estimates, driven by record results in the bank's capital markets unit. The lender's U.S. business also fared better than analysts had expected. That segment, however, remains under an asset cap as part of the gigantic anti-money laundering settlement with U.S. regulators. And TD's boosting its dividend. CIBC beat revenue estimates in its fourth quarter, and it also saw profit climb 16% year over year. Once again, the performance of the capital markets business helped to drive results. And the Toronto-based lender also saw strength in its Canadian and U.S. commercial banking and wealth management operations. The bank is boosting its dividend to $1.07 a share. CIBC is continuing a 2-year streak of earnings beats. EQB is buying PC Financial from Loblaw. The parent company of Equitable Bank says the deal is worth altogether about $1.3 billion, which includes Loblaw's insurance companies as well. Under the terms, EQB becomes exclusive financial partner for Loblaw's PC Optimum program. And PC customers get access to EQ Bank's digital platform and suite of accounts. Loblaw will take a stake of up to 17% in EQB. We are looking at a broadly strong open for U.S. stocks today. Up, the Nasdaq now flat. U.S. stocks not far off record highs. Let's check in on the TSX and how it traded yesterday. Our market, of course, has been boosted by consistently strong reports from the big banks this earnings season. And there's a look at oil. It is holding its own today. And let's check in on gold. It's had quite a rally lately, eclipsed, of course, by silver, which keeps hitting record highs. You can see gold pretty flat today. And finally, let's look at the Canadian dollar. And you can see our currency down marginally against the US dollar, but it has been rallying over the past few sessions. CIBC, BMO and TD all beating earnings expectations in their latest quarter and increasing their dividends. Let's get more from Mike Clare, Senior VP and Senior Portfolio Manager at Brompton Funds. Just the person to crunch these numbers. Mike, thanks very much for joining us. Before we get into the individual banks, are you seeing any themes emerge this earnings season?
Yeah, we're seeing a few consistent themes across bank reporting. Like, first of all, it's been a fantastic quarter across the group for all 6 banks. One of the key themes we're seeing, of course, is capital markets revenues have been very strong across the group. This is a theme we've been pushing on really since the beginning of this year, or late last year. Trading businesses were really doing well early in the year, and they continue to do well, driven by the volatility we've seen in the market, and that sparks more client activity and better trading volumes and better trading revenues for the banks. But lately, we've also seen an uptick in investment banking revenues, which is something we've been expecting to come for some time now, and that should continue into 2026, just on a favorable environment for deal making, particularly in the U.S., where we see regulatory relief driving M&A activities, new equity issuance, and the like. So some of these key themes really driving strong performance for the banks here.
Tell us what jumped out for you at these CIBC results. The bank's been on a roll over the past couple of years in terms of exceeding expectations.
Yeah, so I mean, what jumps out for me really is nothing really jumps out too much, and that's a good thing for CIBC. I think they've done a really good job over the past couple of years, driving like a steady business, focusing on the mass affluent customer in Canada, and that's really driven some more steadiness in their results. Of course, we saw strong capital markets revenue from CIBC, and their U.S. business is doing really well, too. If you look at U.S. commercial banking wealth management, up close to 40% year over year. And then in terms of like the credit market environment, so like obviously credit like provisions have been elevated across the banks, including for CIBC over the past year, a couple of years. We're starting to see some moderation there. So, we expect, credit provisions to remain somewhat elevated but manageable for a bank like CIBC. We saw in the current quarter, impaired provisions are roughly in line with estimates, performing provisions, which is, looking at the potential for loans to go arrears in the future, uptick a little bit slightly. I think they're being a little bit conservative there just on the macro environment. So nothing stands out too much for us on CIBC. It's steady as she goes. We like the bank and they're performing well across all their business units.
Bank of Montreal. Now, correct me if I'm wrong, but there was some concern about credit risk in the U.S. operations. Is that dissipating?
Yeah, that is definitely dissipating. We've seen, going back a few quarters, BMO had some issues with credit provisions, particularly coming out of the U.S. bank. That really has started to moderate now. We saw, for example, in the U.S., just looking at impaired loans actually starting to move lower. Impaired loan credit losses starting to move lower. And that's definitely a positive for BMO, particularly relative to expectations.
And the dramatic story, of course, TD. Investors hoping that they can put these U.S. troubles behind them. Anything interesting there?
Yeah, I think actually the TD's done a really good job putting some of these U.S. issues behind them. So two things going on with their anti-money laundering remediation program. Of course, they had the asset cap in the U.S. where, it was last October, just over a year ago, regulators forced a cap on that business in terms of asset size. Of course, the bank doesn't want to operate right at that cap, so they've spent the last year right-sizing the balance sheet. So they've reduced the U.S. balance sheet by about 10%. That's now complete, so they can drive some business growth there going forward, focus on key customers. And then on the AML side, they're still talking about spending $500 million a year on their remediation program. That's not a surprise, but things are going well there. But this is ultimately something that's going to take another 2 or 3 years to resolve.
What bank stocks do you think offer the best prospects right now, Mike? Say if one had a 5-year time horizon and was looking for total return, dividend plus stock appreciation.
Yeah, I still think I've talked about it in the past. I think Royal Bank is the best operated bank in Canada. Things continue to go really well there across a number of their business lines. And notably, it tends to trade at a premium to the group, but actually that premium has come down versus the group. So we think it's a good opportunity to pick up RBC shares. We also like TD. The other thing that's going on at TD is they've got a cost restructuring program in place. So they've actually expanded that program. So they're spending about, in total, $825 million in restructuring costs up front, essentially to drive ultimately $750 million in annual cost savings. And that's something that could really drive growth in EPS and improvement in ROE closer to their 16% target. So we like both of those banks in particular.
So TD is spending more than $700 million to cut costs. Is that partly severance or? Yeah,
so it's partly severance. They've talked about a 3% headcount reduction. They're also right-sizing the branch network, closing some branches, right-sizing their real estate portfolio, closing some smaller business activities, things like that. So it's various restructuring expenses that go into that, and then that should drive pretty substantial savings on an ongoing basis going forward.
Mike, before we let you go, Laurentian Bank finally coming off the public markets, but National Bank finessing it, not taking on the liability of a branch structure. That's just going to be chainsawed, it sounds like. What did you think? Is National Bank getting a good deal there?
Yeah, I think that looks like a pretty good deal for National Bank, just picking up some balance sheet growth, both on the asset side and the deposit side, without the need for costs in terms of the branch network and people. So it's something we think they can integrate pretty well into the business, and it is definitely a good deal for them.
Mike, always great talking to you. Thanks very much indeed.
Thanks for having me.
That's Mike Clare, Senior VP and Senior Portfolio Manager at Brompton Funds. Okay, we're right in the middle of bank earnings season. And of course, you could argue that every Canadian investor should own some of these big lenders. We're going to get more on yesterday's reports from Royal Bank and National Bank of Canada. That's ahead. Yesterday, we got earnings reports from Royal Bank and National Bank. And on those results, we spoke with Kyle Taylor, Wealth Advisor and Portfolio Manager at TriDelta Private Wealth.
It's good for the TSX, generally speaking, that we're not seeing any surprises. But one of the things that we were watching pretty much across the board was really just any comments around provisions for credit losses. You may remember that earlier in the year, and due to tariffs, they increased provisions for credit losses kind of across the board. RBC was no different. And then, as they saw that loans were continuing to perform, they reduced those provisions, which saw a lot of momentum for the financial stocks, sort of driving up for most of the year, and now we're starting to see those provisionings creep higher, and I don't think that's really any surprise given some of the economic data and genuine fears for the consumer.
Okay, so talk to me about wealth management being strong for both banks. Royal, we'll start there.
Well, I can't say it comes as much surprise for RBC. They were up 33% year over year. As that asset base expands and they continue to take on more Canadians as clients, they're going to generate more fees in that respect. But I think just as quickly as that can happen in a good year like 2025, who knows what 2026 has ahead in terms of how market performance and what they're going to see in that particular segment.
The CEO is giving a conservative push for the forecast. Do you think he needs to be or err on the side of caution at this point?
I certainly do. I think that it's no secret that everyone's sort of a little bit more cautious headed into 2026. Broadly speaking, even just outside of the banks, I think 2025 has been one of the most hated rallies in recent memory that we can really point to, and we're seeing the same comments come out from CEOs and not just the banks, but broadly speaking as well.
All right, let's get to National. Strength in the same unit, capital markets, wealth management. But how has it managed its Western acquisition? How's that going?
Well, expenses, no doubt, were increased. I believe it was about 21%, and that offset some of the profitability that they saw in other segments. But I think generally speaking, it's been a good integration. I think it helps them increase their market share and also gain a bit more of a foothold outside of Quebec. And then, of course, we had the big news earlier this week with Laurentian Bank and Fairstone, and the deals being split between Fairstone and National Bank, and National Bank taking the deposits in some of the SME loans. That should be accretive to return on equity by, I think, we estimate by about 2%. Generally speaking, though, I think we see National Bank as pretty fairly valued today in and around the high 160s, low 170s. And there's kind of limited room for upside on them. But again, there could be some surprises in respect to the integration of Laurentian Bank and, further increase in market share from CWB.
What do you expect from that integration? I don't think National will oversee the closures of the banks in Quebec.
I think it incrementally strengthens their presence in Quebec, which is, of course, their core market. And it seems that, especially in particular yesterday, it was generally well received. Today, I think we're seeing a little bit of a normalization. Earnings really weren't a surprise, and maybe investors felt that the stock got a little high yesterday, and we're seeing a bit of a pullback today.
Okay, let me ask you about the banks and what we've seen so far in reporting, and whether you think it paints a fair picture of what the Canadian economy looks like today.
That's the question, right? It's interesting because, of course, the banks seem to be trading at a premium in the face of significant economic weakness. I really fail to see how the banks can make a material move higher into 2026, but that doesn't mean that earnings can't catch up to multiples if the economy and consumer prove resilient into 2026, 2027. 2026 is another big year for mortgage renewals for Canadians, which will be of acute focus. There's a lot of things on the macro as well, the USMCA renegotiation with Canada, the US, and Mexico that could shift outlooks pretty dramatically. And then, generally speaking, though, I think if we only see a marginal decrease in interest rates from the Bank of Canada in 2026, that still leaves plenty of room for profitability from the banks. I think where the outlook takes a dramatic shift is if we see a swing to that one way or the other in interest rates and how some of the implications for that more broadly.
Do you feel like the lack of a trade deal or a renegotiation on the trade deal is a big overhang for the banks?
I think it's a big overhang for everybody, not just the banks. I think the TSX in general. The one aspect that I can maybe be proven wrong a little bit on the TSX and the bank stocks is if we start to see, as a Canadian market, if we start to see a bit more of the incremental fund flows from international investors. It's no secret that we're seeing a bit of a rotation out of US dollar assets and away from that expensive market to other regions. I mean, Canada is a significantly smaller market than the U.S., and if we saw even 0.5% of those fund flows, that can move the needle in Canada, and the banks being a significant portion of our index, that can help push things quite a bit higher and stretch multiples even further.
Coming up, we're going to get the latest on the fallout from those big job cuts at Algoma Steel. Algoma Steel in Sault Ste. Marie, Ontario, is cutting about 1,000 jobs. People in the city are noticing anxiety in the air. The community is coming together to help those who have been laid off and their families during the holidays. Heather Wright of CTV News has more.
Sault Ste. Marie, Ontario is technically a city, but people who live here say it's more like a small town.
I've been seeing anxiety in a lot of people's eyes for a long while now.
Dan Trevisanute knows his neighbors are hurting, and so he's discounting haircuts and beard trims for Algoma workers impacted by Monday's layoff announcement.
It's the least I can do, and a little bit of affordability to offer these people dignity, because they'll be looking for jobs, and there'll be a lot of people just going to be in a bad way.
1,000 people are set to lose their jobs, a direct impact, the company says, of Donald Trump's tariffs. Tariffs that are hurting people on the other side of the St. Mary's River in Sioux, Michigan.
Definitely, there's been a pinch.
Jennifer Riatoir has owned the mole hole for more than a decade, but in the last year, she's watched as tariffs have squeezed her margins.
Some of our vendors do try as well to absorb it for a while, but ultimately they pass it on to us. We absorb what we can, but we also can't absorb everything. There's just not enough room for it, and so everybody pays for tariffs.
While tariffs are most acutely felt on imported hard goods, prices have also risen at the grocery store.
Everything is going higher, and we're doing okay, but I think there's a lot less fortunate people that have to really struggle.
Back across the border, there are concerns about the impact the Algoma layoffs will have on the broader community. At Peter Ma's normally busy restaurant, this week has been extremely slow.
This is a steel town, and everything is based on Algoma Steel. So if we're laying off 1,000 people, that's a big number of people. We only have 72,000 people here.
The Algoma layoffs don't go into effect until March 23rd, giving affected employees a little less than 4 months to find a new job.
Meanwhile, local residents in BC are disappointed. 3 weeks before the holiday, a Vancouver Island pulp mill will be closing due to tariff pressures. This shutdown of the historic Crofton mill will mean the loss of about 350 jobs. Andrew Johnson of CTV News filed this report.
Most people in Crofton, BC can't remember a time when there was no mill.
It's been an institution of Crofton since the 50s. It's a very big change.
Very upset. I mean, it supported our family and so many families in this town.
Now, 3 weeks before Christmas, 350 workers have learned they will soon be out of a job and the pulp mill will close for good.
It's a real punch to the gut for our whole community. To lose a good union job like this is tough any time of the year, but to get that news right before Christmas is devastating.
Mill owner Domtar says the mill has been losing millions for years, and U.S. tariffs that have been hammering the softwood lumber industry aren't the issue. Instead, the company is blaming government regulations, saying logging approvals that used to take weeks now take years, and they've actually been forced to source wood fiber from the U.S.
It's cheaper and it's more readily available and dependable in terms of its supply, and so that should give an indication to British Columbians of where we're at.
The official opposition claims the NDP government has been using the Trump trade issues as a scapegoat.
Tariffs aren't the issue. That's all we've been hearing in the House. It's Trump's fault. It's Trump's fault. It's not Trump's fault. It's this government's fault.
Today, the Premier acknowledged forestry is in a tough spot.
The combination of pine beetle, the need to protect old growth, forest fire, and low prices is incredibly challenging.
The Premier says the BC government will try to figure out a way to keep the mill open and salvage those good-paying jobs. But for now, Domtar will turn out the lights December 15th. Andrew Johnson, CTV News, Vancouver.
Just to correct something I said leading into that pack, apparently the company not citing tariff pressures here. Let's have a look at U.S. futures as we count down to the opening bells. Looks like we are going to get some upward action on Wall Street stocks, nearing record highs south of the border. And the record close for the S&P 500 was 6,890. Back in late October, 6,890, so we're at about 6,875 right now. Let's have a look at gold, always of interest to our viewers and Canadian investors in general. Gold holding its own up around 1%. Generally, there's optimism, as I just mentioned, in stocks. Silver, I'm not sure if we've time to put in a one-year chart for silver because we did see some selling in silver, some traders taking profits after that surge to record highs. Silver essentially doubling this year, and both silver and gold on track for their best annual performances since 1979. And of course, then I believe it was in 1980, gold went on to climb to record highs. Let's take a break. We got those opening bells coming your way next. Here are those opening bells on Wall Street. At the NASDAQ, Save HIV funding is ringing the opening bell. At the NYSE, it's New America Acquisition One Corporation celebrating its IPO. It's time for the first 50. Trading is just getting underway. Let's check in on the North American markets. And you can see we are getting a positive open right now. The TSX 31,237. So it's higher. We did, of course, get yet more consensus beating earnings from the banks. TSX, though, our composite index, still slightly down from Friday's record closing high. You can see U.S. stocks, though, moving higher as well. And some shares of interest. Let's see how TD, BMO, and CIBC are doing in early trading after all of them beat expectations and increased their dividends. You can see that they're moving up. Dividends, of course, tend to grow steadily from this group. I'm just checking if you were to buy the banks as a whole, i.e. by buying the TSX Banks Index, you would have pretty consistent dividend growth over the years. And so we can see the bank stocks generally trading near record highs. In fact, they did get to a record high yesterday. One stock of interest here, EQB, sticking with banking, it is buying PC Financial from Loblaw. Raymond James commenting, though, that credit remains a problem for this company. Still, it's moving up pretty sharply in trading today. Enlarging their footprint here in this partnership with Loblaw's. Loblaw's taking a stake of up to 17% in EQB as part of the transaction. And let's have a look at BRP, the maker of those residential toys and, not residential, adult recreational vehicles. And that stock has had quite a rally lately, up about 5%. Analysts saying that latest earnings beat expectations. Normalized EPS for the company coming in at $1.59, and that was up from $1.16 a year ago. And the analysts were looking for only about $1.25, and revenue jumping 15% year over year. And let's have a look at Canfor, because Canfor Pulp, I should say, it is being taken private by Canfor. And we already discussed the loss of that pulp mill in Vancouver Island. So there you can see, even though the stock is rallying today on word of this buyout, 50 cents a share, Canfor Pulp still sharply down over the past year amid woes for the pulp industry. Let's get more on some movers south of the border. We're joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Jeff, thanks very much for joining us. Meta shares are up. They're going to cut back metaverse spending.
Apparently, that was the thing that investors wanted to see. Mark Zuckerberg came out this morning and said that the metaverse was going to see a 30% budget cut next year, and the stock just immediately jumped in the pre-market session to one of the top-performing stocks in the S&P 500. So it's definitely worth watching today. When I was at my desk, it was up about 7%, and definitely a stock that is going to be in focus, 5% right now, over the course of the session. Remember, the metaverse was the idea, the next kind of growth idea for Facebook a few years ago, and it was the reason why Facebook changed its name to Meta Platforms. Now it sees less competition in that space, and all of the chips are being shuffled into the AI space and AI spending. So, yeah, you see a big cutback here, and investors clearly happy to see less spending in this area. I should also just note, if we remember a few years ago when they announced their plan to spend so aggressively in this metaverse, the stock also saw a little bit of a sell-off at that time.
That's interesting. Yeah, I remember the metaverse, and Zuckerberg was all over it. We even got a virtual Zuckerberg. That's a high point of human culture, and but people were wary back then. Yeah, it's all about AI now. Calvin Klein's owner is a company called PVH, and the forecast not delighting investors.
Not delighting investors. No, they own both Calvin Klein and Tommy Hilfiger, and they were out this morning with a fourth quarter forecast that looked a little bit tepid, a little bit below what Wall Street had hoped for in terms of earnings per share for the fourth quarter. Bloomberg Intelligence, which is our in-house research division, came out this morning and said that there may be some signs that tariff pressures are mounting on this company, and specifically leading to a little bit of margin erosion here. Citi was also out this morning that said, while the company says that its sales plan for the fourth quarter is on plan, that's a quote, they did lower the plan. So the plan is lower than it previously was, even as they're kind of trying to put a brave face on this. The talk on Wall Street is that while the fourth quarter, it may be driven by a little bit weaker holiday spending, as evidenced by some bigger sales, some bigger discounts that we may have been seeing on Black Friday and on Cyber Monday in the U.S.
Jeff, thank you very much indeed. Jeff Morgan. After this, we're going to get more on the Canadian bank earnings. We'll be joined by market veteran Richard Croft. He says, yep, they've been consistent performers. And right now, it's looking pretty good for 2026. That's after the break. We've been getting consistent earnings beats from Canada's big banks, despite concerns over the economy. Let's get more from Richard Croft, Chairman and CEO at Croft Financial Group. Richard, thanks very much for joining us. Kind of surprising, isn't it, given the threat to our economy with these tariff walls that Trump has erected?
Yeah, well, there's a broader picture there, I think. First of all, the banks, if we have a slowing economy, you're going to get lower interest rates, which improves their net interest margins. If you get a more robust economy because they get some sort of deal in place with the USMCA, that's going to be good for loan growth, and it's going to reduce their bad loan, money they're setting aside for reserves. That reserve money that they're setting aside, of all of which they did and added to, I think gives them a pretty strong defensive position next year, no matter what happens, because I think they're going to benefit either way. The other thing going on here, I think, is that the Canadian banks have a lot of exposure. Certainly the ones that have reported, Royal, TD, Bank of Montreal, and to a lesser extent, Bank of Nova Scotia, have very good business models down in the U.S. So even if the U.S. economy does better and we suffer, they're still going to benefit from some of those things. I think they got a lot of things going for them. There's a lot of tailwinds going into 26.
That's interesting. Even with a weaker economy, interest rates tend to come down, and that's good for their spread, their net interest margin.
Exactly. And if they have a stronger economy, they can lower their reserves. It's a wonderful business because you can manage your earnings so effectively. Raising your reserves manages your amount of earnings in a particular quarter. And of course, if you lower your reserves, that bumps up your earnings. So I think they're in a very good position. They certainly have great capital ratios. And I'll tell you one of the things that struck me with some comments that came from David McKay at Royal Bank, and RBC is trying to get their return on equity up to around 17%. That's a pretty stellar number for any bank. And one of the ways they're doing that is that they have embraced AI a lot more than the other banks have. And I think that you're going to see more of that play into this over the next year. It's one of the rare instances where you're seeing artificial intelligence actually benefit the bottom line of a company at this stage of the development of that era. So it's interesting to me.
Do you think the politicians will ever get the backbone to really go after competition among banks? The Competition Bureau in September of 2024 said that we do have a financial sector that needs more competition, highly concentrated, and it's tough to switch providers. And now the budget talked a bit about that, but do you think Ottawa, I mean, the banks have such lobbying power in Ottawa, do you think they ever will try to break up what many people think is an oligopoly?
I think it's going to be a very big challenge, and I don't think we're going to see it in our lifetime. One of the issues that I have always looked at with the Canadian banks is that Canadians in general prefer the stability that they bring to the table, and they're willing to accept less competition for greater stability. So I think that's where we are at this stage, and that's the psyche of Canadians to start with. Americans went through an awful time during the financial crisis, and part of the problem was they had too many banks, and a lot of them weren't very solvent. So yeah, I don't think we want that here.
I don't know. I just think, shouldn't it be nature red in tooth and claw? Is it that bad if a bank goes bust? I mean, we have deposit insurance for protecting the public, consumers.
Well, we have $100,000 in top profit insurance. I don't know how much that really defends anybody. That $100,000 that they had in place, I mean, I think it's 100 or 150. I kind of forget what it was in the States. But when Silicon Valley Bank went under, there was none of those depositors, most of them, because they were quite wealthy, would have been got their money back. Now, the problem here is I don't think the government has that kind of money anyways. At the end of the day, they'd have to merge that bank with somebody else. So somebody's got to take it over. There goes your competitive edge all over again. You're back to smaller, bigger banks with a smaller group, which, to tell you the truth, is what they did after the financial crisis in the U.S. I mean, Goldman Sachs became a bank, and it was a really, really big bank. And it wasn't that before. So I think we've got more concentration in the U.S. too, because I think they see the value of that relative to the risks involved. Let's face it, the banks become the lubricant of the engine that drives the economy. That's really what it's all about. And if you have stability there, that's what you want. You want an engine that works fine.
I know I'm dwelling on this, but you say lubricant, or are the Canadian banks really sand in the works because they're so conservative with their lending? They won't back entrepreneurs.
Yeah. Well, that's a fair comment. Yes, that's true. Having gone through that myself, yes, I agree with you there. Yeah.
I know, but I wonder.
The more competition would loosen that up, but also make it more risky. So, I mean, it's that trade-off, and that's what we look at as Canadians.
That's a
whole trade-off.
That's interesting. Yeah, you can't. There's no free lunch. Yeah, that's right. Sometimes.
Sorry, go ahead. You go ahead.
Richard, if somebody came to you, and this is a rhetorical question, and said, look, I'm just going to put all my money in Canadian banks, my entire equity portfolio. Yeah. What would you say to them?
I wouldn't discourage it entirely. I think they deserve a place in a portfolio. I think a portfolio should be diversified. I think one of the things you run into is when you get banks, you get a lot of stability, you get a very nice dividend, you've got some comfort that they're going to do all right over the longer term. And quite frankly, the portfolios that have had an excess amount of banks in our group of clients have done very well. On the other side of that, you would have missed some of the rallies that we've seen in gold. Agnico Eagle, for example, has doubled investment this year, things like that. You would have missed most of the AI boom, which let's face it, that's a big part of where the growth is coming from. So it kind of depends where the client is at a particular point. If they're 65 and older, I say, sure, if you're going to have equities, that's a decent place to put it. But I think it still should be part of a diversified portfolio. I was going to say one thing, just about your segment there. You were talking about Meta, because they just actually wrote a piece on that. We're talking about the AI bubble. And one of the things is that I think investors are looking at that as a metaverse moment here. And Facebook got down to $112 in 2022.
Wow.
So it's $675 today. And that was because it was driven lower on the metaverse concept and the fact that he changed his tune and is putting more money. And I think what the industry is looking at is not just a metaverse example. I think they're going to look at, if you're going to invest in AI, I think there's going to be more scrutiny in 2026 in terms of the value you're getting out of that, which goes back to my point on RBC. I think they're getting some value out of the AI, and that increase in margin is a big deal. I think that's one of your themes that's going to play out in 2026 across the spectrum, and we're going to see if AI can fulfill the promises, because I think that's what clients are looking for, investors in general are looking for.
It's interesting. Yeah. The people are going to be more skeptical, as you say, about the billions that are being poured into this stuff. Thank you very much, Richard. Really appreciate it.
No problem. Good seeing you.
Richard Croft, Chairman and CEO at Croft Financial Group. Yesterday on Market Call, we were joined by Kim Bolton, President and Portfolio Manager at Black Swan Dexteritas, covering technology stocks. His top ideas were Microsoft, Meta Platforms, and Walmart. Normally, he's more tech-focused, but of course, Walmart have a huge e-commerce business now. Today on the show, it's Rebecca Telcher, Portfolio Manager at New Haven Asset Management, and she's taking your questions on Canadian stocks. You can email us right now, marketcall@bnnbloomberg.ca with your questions for Rebecca. So EQB is buying PC Financial from Loblaw. The deal is being valued at about $1.3 billion. We'll take a closer look right after the break. EQB, the banker, is, of course, in the news for buying PC Financial, but it just released its own earnings report, and there are some challenges. Let's get more from BNN Bloomberg's Lindsay Biscaya.
And really, Andy, the CEO of this company, a relatively new CEO for EQB, saying that fiscal 2025 has really just been full of challenges for EQB. And this quarter reflecting that as well. Missing estimates this time around. It appears credit remains an issue for EQB, with the bank reporting an adjusted earnings per share of 1.5. That's compared to the consensus of 1.9. Also an adjusted net income of $63.5 million. Credit has been a problem for this company in the past as well in 2024. And Chadwick Westlake, that new CEO, saying the company responded this time around by announcing a one-time restructuring program, which drove a charge of $92 million pre-tax. So there is a call this morning, an earnings call at 10:30, expecting to maybe learn more about what happened this time around in that call. But the stock price actually doing pretty well today for EQB, and that might also be because of some other news that you mentioned off the top that EQ is announcing.
Yeah, so they investors seem pleased with the shares up 10%, that they're getting much bigger with this deal to buy PC Financial.
Yeah, this is a pretty big deal. It's an $800 million deal to buy PC Financial. PC Financial is the financial services brand behind Loblaws, obviously the big grocery chain here in Canada. And the idea here is that both companies have kind of pioneered that no-fee, higher interest account idea. But now you're combining the two when it comes to digital services as well as access to in-store and ATMs and credit, because EQ Bank will now be taking on the 7th largest credit portfolio in the country with 2.5 million customers. And then also EQ Bank itself has 800,000 customers that PC Financial and Loblaws is now gaining access to. So in terms of how this actually benefits customers, PC Financial customers will now get access to EQ's digital services. They've got a pretty popular app as well. In return, EQ Bank customers can benefit from PC Financial's credit cards, PC Optimum, of course, as well as access to all of those Loblaws locations, 2,500 stores and ATMs across the country. And this is also believed to benefit Loblaws in an interesting way, because now with this digital access, the chain will be able to see data in terms of how its customers are shopping and actually tailor advertisements to its customers through what they can see through the EQ Bank digital platform. And also, of course, Loblaws will now own a minimum of 17% of EQB's outstanding common shares. So this obviously still up for regulatory approval, but that's expected to happen early next year.
Fascinating, yeah. And of course, there's bonus. You may have touched on this, but Loblaws gets access to EQB's customers here.
Exactly, 800,000 customers of EQB's. Yeah, so they're both kind of benefiting from this.
Yeah.
And it's expected to be quite a big deal. Yeah.
EQB putting itself on the map here. Thank you very much indeed. Lindsay Biscaya. Okay, we've got lots more coming up. We are going to check out some early market movers, including those big banks. There may soon be fewer Air Transat flights, and that could happen as soon as next week. The carrier's roughly 700 unionized pilots will be in a position to strike. CTV's Annie Bergeron-Oliver has more on this.
There may soon be fewer Air Transat flights on the runway. This time next week, it's roughly 700 unionized pilots will be in a strike position.
A December strike will be catastrophic because capacity is already saturated. Other airlines like Air Canada and WestJet are flying full plane for the holidays.
This holiday, millions of people are expected to move through Canadian airports, and many will be boarding Air Transat flights. The timing, experts say, puts pressure on an airline already struggling financially.
They're going to push Transat to the wall. Transat's going to realize that the loss of revenue and the impact on market share will be such that paying the pilots would be the least worry for Transat.
The strike threat comes nearly a year after talks began. The pilots are pushing for pay raises, job security, and better working conditions. In a statement, the union says, "Let us be clear, we do not want to strike. However, after nearly a year of slow bargaining and little progress, we urge management to utilize the remaining time and negotiate seriously to avoid operational and flight disruptions." The airline says it's confident an agreement can be reached. Although this is a common step in the collective bargaining process and does not mean that a strike will be initiated, we remain fully committed at the bargaining table and aim to reach a tentative agreement without labor dispute.
97% of these negotiations result in no disruption of labor. So let's hope that they continue to have those conversations in earnest and protect their industry, their employees, and of course the many passengers that are relying on them.
Air Transat says its operations are currently running as normal. Both sides have to give 72 hours notice before either a strike or a lockout. Omar.
Annie Bergeron Oliver, our colleague at CTV News. Let's check out some stocks of interest on the TSX. And of course, we did get more big bank results with dividend hikes and better earnings than expected. And you can see TD Bank, which has had a sharp rally over the past few months, up slightly. Bank of Montreal losing a little bit of altitude. CIBC up higher. Now, my guess is that CIBC is hitting a new record today. Just give me a second. We did see the bank stocks as a group hitting a record high in the past few sessions. The Canadian banks just seen as a winning proposition. Actually, no, that's interesting. CIBC is still marginally down, only very slightly down from its record high in mid-November. BRP, the maker of Sea-Doos and Ski-Doos, posting stronger than expected earnings, and you can see that stock jumping 4%. Canfor Pulp is being taken private by Canfor buying out the shares that it doesn't already own at around 50 cents a share. Canfor moving up, but you can see that stock has suffered. Descartes Systems has been under pressure. They're a huge supply chain software company. They're seen as at risk of a drop in world trade, but getting an upgrade today from Raymond James, and that stock moving up. Lots more after this. Okay, thanks very much indeed for tuning in to the Open today. Let's get to the big stories we're bringing you from our newsroom. Shares in Bank of Montreal slipping a little bit today, but the lender did beat earnings and revenue estimates in its latest quarter. However, investors seem to be focusing on a drop in net profit. BMO says that was lower due to the reversal of a legal provision in the previous year, a write-down related to its planned sale of branches in some U.S. markets, and costs related to acquisitions. In October, BMO struck a deal to sell 138 branches in 11 states to First Citizens Bank and Trust. TD Bank posted profit and revenue in its latest quarter that topped estimates. That was driven by record results in the capital markets unit. The lender's U.S. business also fared better than analysts had expected. That segment remains under an asset cap as part of the bank's anti-money laundering settlement with U.S. regulators. TD also boosted its dividend. CIBC beat revenue estimates in its fourth quarter and also saw profits surge 16% year over year. Once again, there was a strong performance in the bank's capital markets business, and the Toronto-based lender also saw strength in its Canadian and U.S. commercial banking and wealth management units. The bank is also boosting its dividend quarterly to $1.07 a share. CIBC is in fact continuing a 2-year streak of earnings beats. TSX higher in early trading, boosted, of course, by those bank results. Let's have a look at the U.S. markets. U.S. markets now slipping, which is interesting. The S&P 500 down about 0.1%. And as you can see, the NASDAQ, often more volatile, down about 0.25%. Stocks, though, of course, in the United States near record highs. And let's have a look at gold. See how that is faring. And gold slightly down in early trading. And finally, the Canadian dollar. Let's have a look there. And the Canadian dollar, again, flat, absolutely flat against its U.S. counterpart. BMO, CIBC and TD beating on earnings and lifting their dividends. Is now a good time to buy those stocks? Let's get some ideas from Grant White, portfolio manager at Endeavour Wealth Management. Grant, great to see you as ever. Thanks very much.
Yeah, always my pleasure, Andy. Good to see you.
Start off with BMO. Your basic verdict on that stock is a hold, but you're tilting towards buying it?
Yeah, so actually, I think after this report, we're in buy mode right now, actually, to be quite honest. And so, what we really liked out of this report is that things got a little bit cleaner on the BMO side. We've liked BMO for a long time. We've been buying into it, frankly, over the last few years. And so it's been a great core holding for us. But, I think that things are clearing up a little bit. We love that the loan loss provisions are cleaning up a little bit, especially on the United States side of things, which is a big part of the business. We love seeing our Canadian banks with a little bit of diversity in the revenue streams. And so BMO is, I think, very well positioned right now. The report was nice from a beat perspective, but, where the revenue is coming from is also really important to us. And we're seeing a lot of diversity there, especially compared to the other Canadian banks. And so from all those reasons, we decided to switch actually just this morning into a buy on BMO. Now, the other thing I really like on it is pricing, to be quite fair. And I think we're getting a good price. We're getting good value right now with BMO, and especially compared to their peers. So, good pricing combined with diverse revenue streams is a good thing right now for BMO.
TD Bank, this is a hold, but perhaps a buy for speculators or investors with more of a speculative bent?
Yeah, I would say TD, we still actually are maintaining our same position. So we're in a hold. The reason why we put a bit of a speculative buy on it is because, we know TD is a good company and we believe that they will figure things out. We're not buying it right now today, but we are holding it. This was a good report. I mean, this is not to take away from a good report. I think TD is doing quite well on a number of areas. I mean, especially, following the fallout, if you will, of a couple of years ago in the United States. I think they're navigating that really well. I think they're earning back the trust. I think that the revenue streams are diverse there. I would love to see a little bit more out of the other revenue streams aside from the net interest income. So if we can see a little bit more out of the wealth management business, we can see a little bit more out of insurance, then I think we're going to be into buy mode. But for right now, we still have it as a hold. But it's a good report. Everybody should be very happy as a TD shareholder today.
Okay, and then finally, CIBC, and CIBC, what's your verdict there? That stock near record highs.
Yeah, CIBC is really interesting because, we have it again as a hold, but more of a speculative buy if you're interested in taking a bit of a leap on it. I think that, CIBC, again, another fantastic report. They're doing a lot of the right things, but I do think that there's better options out there in the Canadian banks, with BMO being one of them. And so, primarily for that reason, we're not buying into CIBC. As I said earlier, I love a Canadian bank with a diversified revenue stream, and I'd love to see CIBC do more of that going forward. They've done great on capital markets. I mean, that can't be taken away from them. Really good job. But, I'd love to see more out of diversity, whether that's from a geographic perspective or from their other revenue streams like wealth management and you name it. And so for all those reasons, I think CIBC remains a somewhat speculative buy. I mean, this isn't a high risk speculation here. It's a Canadian bank at the end of the day, but it's a speculative buy as compared to its peers in my mind. And it's just because of that. I mean, I think there's a little bit more risk on the table. I don't love the exposure to debt lending and housing. I don't love that. And I think there are some ripples that could come out there. But overall, really great report. We're going to keep it as a hold for now. But if you want to take a bit of a flyer on a Canadian bank, CIBC might be the one you take a bit of a flyer on.
And sorry, did you say residential exposure, mortgage exposure at CIBC?
Yeah, that's a little bit more of the concerns that I see today. And it's just more because they're so tied domestically here in Canada that I see a little bit more risk there as compared to some of their peers. And especially, again, when I'm comparing it to a BMO, I'm just seeing a higher quality offering at BMO right now that it's a lot easier for us to buy into it. And especially if you're basing it on pure pricing, CIBC looks great. But I think that we're doing pretty well with BMO on pricing, and we're getting a much better quality, if you will, out of BMO in terms of just a holding. And so from the fundamental side, I love BMO. But that saying, if you're just looking at pure pricing and you think that CIBC is going to do quite well, especially in the areas they've already done well in the capital markets, if you're not worried about residential debt structuring in Canada, then you might do quite well with CIBC as well.
What about Royal? It's almost like a knee-jerk choice, I think, among portfolio managers. Would you be a buyer of Royal?
Yeah, we still like Royal. We've been, we're not actively buying Royal today, to be quite honest, but we've held it for a long, long time. We'd be putting more money into BMO today than we are into Royal. But Royal is absolutely quality. And I'd put them in the same breath as where we have BMO. Diverse revenue stream is really important to us. They've done really well on that front, and they've done that well for a long, long time. It's more of a pricing opportunity in my mind. And so I think that we're getting better pricing out of BMO. If we got better pricing out of Royal down the road, then we might look to switch that. But as of right now, Royal and BMO are both of the highest quality in my mind. And so I think you'll do just fine there. I'd just be very careful on the pricing. As we know, we've seen a huge run up in bank shares this year, which is great. But you got to be careful on pricing going forward. That's my only comment on that. But overall, Royal is a fantastic company as well. Just be careful on pricing.
Oh, Grant, thank you very much. It's always great to hear from you.
Yeah, my pleasure, Andy. Take care.
Grant White, portfolio manager at Endeavour Wealth Management. Coming up, our guest says despite woes in the condo market, investment in multi-suite residential real estate ticked slightly higher in the latest quarter, despite sluggish demand. We'll get more after this. Let's have a quick look at the markets. We'll start off with the TSX, see how it's doing. Moving higher up, 0.5%. We touched on this. Bank of Montreal shares under a little bit of pressure, down about 1.5% after the latest quarter. But the other banks thriving. Royal Bank of Canada just posted a profit record this week. That stock ahead about 2% in morning trading. And just about all of the other banks up. BRP, we looked at that stock, DOO is the symbol. Those shares jumping 6% in early trading. Thank you, control room. After profit came in ahead of analyst estimates. And Descartes Systems, maybe we could have a quick look there. That they specialize in global supply chain software. They'll handle your logistics and your infrastructure. People have been worried about the pressure on global trade because of the US tariffs, and also in general, software stocks out of favor. However, those shares getting an upgrade at Raymond James, and it looks like the market agrees that there's a value there. So Algoma Steel in Sault Ste. Marie is slashing jobs. People in the city are noticing anxiety in the air. The community is also coming together to help those who've been laid off and their families during the holidays. Heather Wright of CTV News had more.
Sault Ste. Marie, Ontario is technically a city, but people who live here say it's more like a small town.
I've been seeing anxiety in a lot of people's eyes for a long while now.
Dan Trevisanute knows his neighbors are hurting, and so he's discounting haircuts and beard trims for Algoma workers impacted by Monday's layoff announcement.
It's the least I can do, and a little bit of affordability to offer these people dignity, because they'll be looking for jobs, and there'll be a lot of people just going to be in a bad way.
1,000 people are set to lose their jobs, a direct impact, the company says, of Donald Trump's tariffs. Tariffs that are hurting people on the other side of the St. Mary's River in Sioux, Michigan.
Definitely, there's been a pinch.
Jennifer Riatoire has owned the mole hole for more than a decade, but in the last year, she's watched as tariffs have squeezed her margins.
Some of our vendors do try as well to absorb it for a while, but ultimately they pass it on to us. We absorb what we can, but we also can't absorb everything. There's just not enough room for it, and so everybody pays for tariffs.
While tariffs are most acutely felt on imported hard goods, prices have also risen at the grocery store.
Everything is going higher, and we're doing okay, but I think there's a lot less fortunate people that have to really struggle.
Back across the border, there are concerns about the impact the Algoma layoffs will have on the broader community. At Peter Ma's normally busy restaurant, this week has been extremely slow.
This is a steel town, and everything is based on Algoma steel. So if we're laying off 1,000 people, that's a big number of people. We only have 72,000 people here.
The Algoma layoffs don't go into effect until March 23rd, giving affected employees a little less than 4 months to find a new job.
After the break, we are going to take another look at these massive record-breaking flows into exchange-traded funds in Canada. That's ahead, the ETF report. So we touched on these figures with Valerie Grimba of RBC just a few days ago, but it bears repeating. The massive flows of money into Canadian ETFs this year. National Bank calculates that it's been over $100 billion so far in calendar 2025, and 1 month is still remaining. Just in November, there was a new monthly record, $13.8 billion going into ETFs in this country. And Canadian equity came back into favor last month. And there were also sector flows into energy and financials. Now, the report, I don't think mentions XEG, but that's one energy ETF that's out there, the iShares energy producer ETF. There's a look, and you can see the performance of the Canadian energy stocks has been pretty darn good, given the oil is stuck below $60 US a barrel lately, because, of course, the oil sands companies are churning out cash flow. So that's a new record, almost $14 billion in 1 month coming in November. And that topped the record in March of this year of about $13.5 billion. There were flows of north of 600 million into these inverse levered ETFs, including the relatively new lightly levered subcategory. And apparently, in the latest month, both retail demand and institutional activity spurred the demand. Meanwhile, though, south of the border, and we've seen this to some extent as well in Canada, there's been the advent of levered ETFs. Some of them offer you just exposure to one stock on a double basis. You'll get twice the move up in a stock in a single session, or twice the move down. In some cases, you don't want to be holding these things for the long term. Now the U.S. Securities and Exchange Commission is warning some of America's most prolific providers of these so-called high-octane ETFs, that's Bloomberg's phrase, effectively blocking the introduction of products that were designed to deliver 3 and even 5 times the daily returns of stocks, commodities, and crypto. So the SEC has written to firms including Direction, ProShares, and Tidal that it won't review these proposed launches until important problems are addressed. Apparently, at the heart of the concern here is that these funds' risk exposures may top SEC limits on how much risk a fund can take relative to its assets. Because, of course, we've seen these ETFs coming out that are essentially gambling on stocks. And as I say, some of them are designed just to capture the one-day move. So you don't want to be holding them for the long term. So we've had a slump in investments in Canada in multi-suite residential business like condos and apartments. In fact, earlier this year, it hit a 5-year low. However, a guest says the market ticked higher in Canada last quarter. Let's get more from Keith Redding, Senior Director of Research at Morguard. Keith, thanks very much indeed for joining us. So we have seen this weakness in condos, particularly in Toronto. Too many small units were built. But lately, we've been seeing something of a recovery in the multi-residential market.
Yeah, it's been, I would say, a modest recovery. We certainly, activity levels are far below what we'd become used to. There was a lot of sort of speculative activity when, borrowing costs were very low for a substantial period of time. And so we had a market that was speculative in nature. We had some, particularly in markets like Toronto, as you said, we had some flipping of condos. So people would purchase a condo as an investment. with the hopes of flipping that condo before it was completed, because we had this really excessive demand in the market. We've since had a correction to that as interest rates increased, even though they've come down a bit over the past year. But we're at a point where there's a lot of opportunities to buy, and there's a lot more listings than we've been used to. And so, consumers and investors have more choice in the residential market. And so some have gotten back into that market.
And your numbers here are tracking transactions, sales of these buildings, with the cutoff being a $10 million price.
Correct. Yeah, we tend to track the top end of the market, so the bigger sales of particularly apartment buildings. These are purpose-built rental buildings, and yeah, we've seen an uptick in demand. Residential, typically, people need a place to live regardless of the economic environment, and the rental sector has performed relatively well historically, and so we're seeing more and more investors, both private and institutional to a lesser extent, looking to get into the apartment market.
Who are the big buyers of apartment blocks these days? Can you generalize?
Yeah, I would say it's large private groups. We've seen a little bit of activity from some of the real estate investment trusts. What they've been doing is selling some of their older assets and purchasing newer assets that are less capital intensive, and they tend to be attractive to renters. So we've seen some portfolio recycling, particularly with names like Boardwalk REIT, and where, again, they're looking to upgrade their portfolios for the long term. But there's a lot of private capital out there that's also interested in acquiring properties in premium locations. Perhaps they need a bit of capital injected into them to bring, as units become vacant, to upgrade them, and then they can push the rents a little bit on those as well. So I would say, generally it's the private capital groups, but again, REITs have been active as well.
What about offices? You are seeing something of a bounce in the downtown Toronto office market?
Yes, we saw with the banks, some of the major banks and some of the government agencies and departments bringing their employees back on a more frequent basis into the office. And that's generated some real positive momentum that we haven't really seen in the office market since, the early part of this decade, in part due to the pandemic. It's been pretty choppy since the pandemic, but the last little while, as I said, with the return of employees to their offices, that's really created some positive momentum. We've had a couple significant trades of major office buildings, 2 in Vancouver, recently, where that market, in fact, the market across the country was really very quiet. So we saw the sale of the Post, and then also 750 West Pender. So 2 pretty significant sales that we really haven't seen in the last few years.
And we've only 30 seconds. What about warehouses? They were such a hot commodity during COVID for e-commerce. What's happening there?
So we've had a bit of leveling in the industrial market. We had, as you mentioned, over the last few years, a really strong pickup with respect to increases in e-commerce. It was largely driven by online shopping. Things have settled down a little bit, but the picture for industrial is really quite healthy and stable. We've got more availability, but it's still at low levels. Our construction cycle has slowed, so we've got decent demand and a slowdown in the delivery of new construction, and so that's had a stabilizing effect on the market.
Thanks very much indeed for joining us. Really appreciate it, Keith. Keith Redding, Senior Director of Research at Morguard. Now, we know that AI and its massive power demands are putting stress on the electric grid, but there are some nuances here and perhaps opportunities for investors. We were joined by the CEO of Domini Impact Investments.
We do see that there is quite a demand for energy related to the AI data center build out. And with the cheap cost of both solar and the onshore utility scale wind, the renewables are really having their moment to shine. We're looking at traditional renewable companies like First Solar. So they are focused on utility scale solar and are really seeing that increase in demand being a tailwind for their company. But one of the things that's also helpful to them is they have a US-based manufacturing plant that aligns that domestic content requirement incentive well for them.
And what other companies are you keeping an eye on right now with this?
Yeah, so one of the things that we like very much about the AI and data center build out is the broadening out that we see in choices. So while the renewables are cheap and a great source of energy and good investments for us, we're also finding these other companies that can benefit. So things like fiber, grid modernization, grid hardening, and storage plays that come in. So, starting off with a company like Corning. So it's a well-known name, been around for 174 years. First started with the light bulb and then cookware and then moving on to Gorilla Glass. But now really focused on, they're building out a plant in Michigan to create solar wafers. So this specialization in glass and optics, really positioning them well. So solar panels have not been built here in the US for more than a decade. Currently China produces the vast majority of those, but moving that now onshore here to the US. At the same time, not just focused on the solar renewables, Corning also with his optics specialty is able to pivot and embrace in a partnership for the data center build out. So they have a partnership with Broadcom to supply some of the key components for the optical solutions that will help to accelerate their the AI data center processing capacity. In addition to that, so like I say, Corning, older, well-known, not only in the solar space, but also the data center build out. You can come across a company like Comfort Systems, which is up about 90% over the past year. And most people would have thought of this as kind of a sleepy HVAC company, but is a company providing mechanical, electrical, and plumbing services, really being a major beneficiary of this AI data center boom. Because if you think about a data center with its high density computing power, complex systems needing both power and cooling, they are uniquely positioned to provide those services. When you look at the percentage of the budget of a standard commercial build for the HVAC, it's significantly lower than the overall budget of a build out for a data center that goes to that HVAC energy and cooling. But Comfort has a nice spot in the market because in addition to providing these services that are very much needed in that environment, they also have this very innovative modular design where they're able to make the build in their factories, install it virtually to a wall, and then just bring the wall and install it as a modular construction. So making the data center build very quick and very efficient. I like to say, sometimes we talk about the AI trade and we get back to the picks and shovels. And I think Sienna is also a good example of that. It's been a very strong holding for us, really benefiting again from its role in supporting AI and data centers with the high-speed optical network. So where earlier I talked about Corning, think about Corning as developing the highway, but think about Sienna as the traffic system that helps manage the traffic there. Really helping to connect those data centers, boost performance, enhance reliability and management of the data. And as you can see here, up about 178% this year. So quite a broad array, not just renewables, but those infrastructure plays that are needed as we move to the AI and data center needs.
Mike just wants to jump in with a question here.
Oh, thanks. Carol, do you have any concerns about IRRs going forward, given the escalated cost of capital, both on the debt side, but also now on the equity side, given what we're seeing in private equity, private credit space?
Well, I think, we've talked about valuations and how they're very high and they're priced for perfection. I think, there will definitely be winners and losers as we go forward. We know anytime we're looking at an innovative, disruptive technology, that can be a risk. People, I think, primarily have been dealing with that through diversification and sort of mission critical functions. So thinking about maybe owning a basket of these stocks and opportunities rather than sort of just riding one horse, but also thinking about how critical is it, and is there any, is there a unique mode or a unique opportunity for the company that will provide stability and help support that valuation?
Coming up, Bank of Montreal shares under pressure today amid what analysts fear could be weakness in their domestic Canadian results. We're going to have more on the bank reports after this. We've got more bank earnings and headline profit beats. CIBC, BMO and TD reporting. Banks increasing their dividends, and CIBC set a profit record. We were joined by Mike Clare, Senior VP and Senior Portfolio Manager at Brompton Funds.
First of all, it's been a fantastic quarter across the group for all six banks. One of the key themes we're seeing, of course, is capital markets revenues have been very strong across the group. This is a theme we've been pushing on really since the beginning of this year or late last year. Trading businesses were really doing well early in the year, and they continue to do well, driven by the volatility we've seen in the market, and that sparks more client activity and better trading volumes and better trading revenues for the banks. But lately, we've also seen an uptick in investment banking revenues, which is something we've been expecting to come for some time now, and that should continue into 2026, just on a favorable environment for deal making, particularly in the U.S., where we see regulatory relief driving M&A activities, new equity issuance, and the like. So some of these key themes really driving strong performance for the banks here.
Tell us what jumped out for you at these CIBC results. The bank's been on a roll over the past couple of years in terms of exceeding expectations.
Yeah, so I mean, what jumps out for me really is nothing really jumps out too much, and that's a good thing for CIBC. I think they've done a really good job over the past couple of years, driving like a steady business, focusing on the mass affluent customer in Canada, and that's really driven some more steadiness in their results. Of course, we saw strong capital markets revenue from CIBC, and their U.S. business is doing really well, too. If you look at U.S. commercial banking, wealth management, up close to 40% year over year. And then in terms of like the credit market environment, so like obviously credit like provisions have been elevated across the banks, including for CIBC over the past year, a couple of years. We're starting to see some moderation there. So, we expect, credit provisions to remain somewhat elevated but manageable for a bank like CIBC. We saw in the current quarter, impaired provisions are roughly in line with estimates, performing provisions, which is, looking at the potential for loans to go arrears in the future, uptick a little bit slightly. I think they're being a little bit conservative there just on the macro environment. So nothing stands out too much for us on CIBC. It's steady as she goes. We like the bank and they're performing well across all their business units.
Bank of Montreal. Now, correct me if I'm wrong, but there was some concern about credit risk in the U.S. operations. Is that dissipating?
Yeah, that is definitely dissipating. We've seen, going back a few quarters, BMO had some issues with credit provisions, particularly coming out of the U.S. bank. That really has started to moderate now. We saw, for example, in the U.S., just looking at impaired loans actually starting to move lower. Impaired loan credit losses starting to move lower. And that's definitely a positive for BMO, particularly relative to expectations.
And the dramatic story, of course, TD. Investors hoping that they can put these U.S. troubles behind them. Anything interesting there?
Yeah, I think actually TD's done a really good job putting some of these U.S. issues behind them. So 2 things going on with their anti-money laundering remediation program. Of course, they had the asset cap in the U.S. where it was last October, just over a year ago, regulators forced a cap on that business in terms of asset size. Of course, the bank doesn't want to operate right at that cap, so they've spent the last year right-sizing the balance sheet. So they've reduced the U.S. balance sheet by about 10%. That's now complete, so they can drive some business growth there going forward, focus on key customers. And then on the AML side, they're still talking about spending $500 million a year on their remediation program. That's not a surprise, but things are going well there. But this is ultimately something that's going to take another 2 or 3 years to resolve.
What bank stocks do you think offer the best prospects right now, Mike? Say if one had a 5-year time horizon and was looking for total return, dividend plus stock appreciation.
Yeah, I still think I've talked about it in the past. I think Royal Bank is the best operated bank in Canada. Things continue to go really well there across a number of their business lines. And notably, it tends to trade at a premium to the group, but actually that premium has come down versus the group. So we think it's a good opportunity to pick up RBC shares. We also like TD. The other thing that's going on at TD is they've got a cost restructuring program in place. So they've actually expanded that program. So they're spending about, in total, $825 million in restructuring costs up front, essentially to drive ultimately $750 million in annual cost savings. And that's something that could really drive growth in EPS and improvement in ROE closer to their 16% target. So we like both of those banks in particular.
So TD is spending more than $700 million to cut costs. Is that partly severance or?
Yeah, so it's partly severance. They've talked about a 3% headcount reduction. They're also right-sizing the branch network, closing some branches, right-sizing their real estate portfolio, closing some smaller business activities, things like that. So it's various restructuring expenses that go into that, and then that should drive pretty substantial savings on an ongoing basis going forward.
Mike, before we let you go, Laurentian Bank finally coming off the public markets, but National Bank finessing it, not taking on the liability of a branch structure. That's just going to be chainsawed, it sounds like. What did you think? Is National Bank getting a good deal there?
Yeah, I think that looks like a pretty good deal for National Bank, just picking up some balance sheet growth, both on the asset side and the deposit side, without the need for costs in terms of the branch network and people. So it's something we think they can integrate pretty well into the business, and it's definitely a good deal for them.
Mike Clare of Brompton Funds. Yeah, BMO Personal and Commercial Banking in Canada, apparently concerning some investors. Reported net income, $752 million, relatively unchanged from the prior year, although there was a 5% in adjusted net profit in Canadian banking. But apparently that slow or no growth in profit from that area worrying some investors. Coming up, hot picks. We're going to check out 3 plays in software. Now it's time for Hot Picks, and our guest has MongoDB as his top idea. He says the company is set to benefit from growing use of generative AI. He says as companies build and launch more of these applications, they will rely more on Mongo's databases. We're joined by Tyler Radke, Senior Equity Research Analyst at Citi. Thanks very much indeed for joining us. Tyler, can you remind us, what does MongoDB actually do and how does it fit into the AI business?
Yeah, so MongoDB is a provider of databases. Databases are essentially the foundation for building applications. So everything from a traditional SaaS application like a Salesforce.com to a mobile application to something that might be customer facing or back office facing, all of those need things like a database to store, manage, and run that data. This is a very large market today, over $100 billion. Obviously, you have companies like Oracle dominating the space. But I think what's really interesting about Mongo is one of the big breakthroughs that we've seen on the AI side is just how easy it is to write code, right? You've seen many of these code completion, vibe coding startups really drive explosive growth, and the output per developer is increased in terms of orders of magnitude. So what does that mean? It means that more lines of code are being generated. You need more databases to store and manage this data. And I think the pace in which you're modernizing legacy applications, so there are applications that were written 20, 30 years ago, that's becoming a little bit easier and happening a little bit faster. And so we think that can be an accelerant to growth. They reported earnings earlier this week. We saw their Atlas cloud revenue accelerate to 30% plus. They have a new CEO who's bringing in, I think, a lot of Fortune 500 relationships. So we think there's a lot of positive tailwinds ahead for the business.
Snowflake is seen as another winner in AI. Remind us what they do and what is their AI angle, please, Tyler.
Yeah, sure. So similar to MongoDB, they are in the database space. They specialize more in data for analytics and for doing business intelligence and those types of use cases as opposed to databases. So these are sort of two distinct markets. Been a very high growth business since its IPO. They did report last night, kind of missed expectations after the bar was pretty high. As you can see, the stock has had a good run this year. But their secret sauce on AI is basically, I think they've done one of the best jobs of actually embedding AI capabilities into their products. So what does that mean? Typically, Snowflake, if you looked at this product in the past, you would have to be an expert in writing SQL queries. You would have to know how to code and be more of a technical user of the product. Today, you can use their Snowflake Intelligence product very much like you and I would interact with a natural language search, ChatGPT. You can ask questions about the data that sits under Snowflake. And so basically this is opening up a wider range of users that can engage with the product, and they make money based off the number of queries you have. So we're really seeing the growth rates accelerate. I think this quarter was a little bit of a blip, but we expect them to return to growing their revenue over 30% next quarter.
That's interesting. So you get billed on the number of queries your employees put through?
Exactly. And it's similar for Mongo. And I think the reason why these are some of our top picks, right, is that in software, the software sector has been under a lot of pressure. And I think there's a lot of uncertainty in terms of the way that software applications are going to look long term, right? Because many of these traditional software businesses, whether it's Salesforce or Workday, et cetera, they charge based on the number of seats the number of users, right? And so clearly there's a lot of uncertainty. What is white collar jobs going to look like? What is knowledge workers, developer headcount going to look like? But we do know data volumes are increasing. We think the number of queries are going to grow. So structurally, I think these business models and their technology is just kind of better positioned for what's coming.
And finally, what many people would think is an old reliable in software, Microsoft. What is particularly catching your eye about this name right now, Tyler?
Yeah, look, I think Microsoft is, in our view, this should be a core mega cap holding, right? It's sort of been our view for the last 5 years, and I think it's generated amazing returns. Clearly, the stock is pulled back a good amount from its highs. I think anytime you do get these pullbacks, they're great times to add. I'd say specifically on the business, what gives us conviction. If you look at last quarter, well, yeah, maybe you could say the Azure growth was a little bit underwhelming. We were really impressed by the bookings that you saw. So the commercial bookings meaningfully accelerated. So they're signing a lot of these large deals. Some of those are with OpenAI and everything, but a lot of this is coming from their large corporate clients. And so we think as they get new capacity on, these PowerShells stood up, you're going to see their Azure revenue growth accelerate. We think this company can grow earnings per share well over 20% over the coming years. They're well positioned on AI and doing everything right in terms of operating with discipline. They're holding operating margins. They're not going into kind of more speculative businesses, and we just think that can kind of drive compounding growth over time.
Tyler, we better leave it there. Thank you very much indeed.
Thank you.
Tyler Radke, Senior Equity Research Analyst at Citi. Really appreciate it. Coming up, we are going to check in on the trading on Bay Street and Wall Street. You are watching The Open. Let's check out how the markets are doing right now on Bay Street and Wall Street. There is the TSX, and we got yet more earnings beats from the big banks in general. But as I mentioned earlier, there are some concerns about apparently slow growth or even weakness in this quarter in the core personal and commercial banking operations at Bank of Montreal. So we are seeing some selling in that stock. All three banks, though, increasing their dividends. Here's what RBC has to say about BMO. Sure, the results were ahead of estimates, but that was partially offset by weaker results in Canadian P&C. Let's have a quick look now at Microsoft, because Tyler Radke of Citi pointing out that the company has avoided some of the more speculative investments, trying to keep risk under control. Interesting story, though, on the information, which is a widely read business information website. Apparently, Microsoft is having trouble getting customers to spend money on newer AI products known as agents. Some corporate customers saying it's hard to measure how much we're actually saving using the AI technology. And it can be difficult to get the AI to work perfectly. And you do want that in things like cyber security or automating finance. You don't want error. So interesting how Microsoft is off its record highs there. Another couple of stocks on our radar, BRP. Let's have a quick look at Bombardier. That stock surging over the past year, up more than 50%. And investors like the look of the latest results. Thanks for watching The Open. Morning Markets is next.